Thanks for the organizer, for Grace and Annette, for putting the paper on the program. This is how competitive in the stock market, and this is joint work with Valentin, who is here, and Paul, who is a graduate student at UCLA, also here. Okay, so what got us started working on this paper is like a very important question in finance, which is what happens to equilibrium prices when some institutions of investors decide to change their trading strategy. And the standard answer in finance is that actually nothing happens. And the rationale for that, what people say is that markets are very competitive, and so prices are just going to fix themselves somehow. But if you dig a little more, what people have in mind is that the direct effect of some investors changing their trading strategy is going to be counteracted by maybe other investors actually adapting and responding to the initial change in strategy. So to take the example that we're going to study today, if you have a rise in passive investing, some investors become passive, maybe other investors on the market are going to start trading more actively, undoing the initial effect. You can also think about the different example of think about arbitrage. And if some people stop looking for $20 bills on the floor, others are going to pick up the slack and start looking for them very, very actively. Now, when people say markets are very competitive, what they have in mind is that the response actually undoes all of the direct effect such that equilibrium prices are actually not moving. Now, what we do in this paper, we're actually asking and answering the question, how large is this competitive response? Now, once we're going to have a number for this competitive response, we'll just plug in the rise in passive investing, and we'll be able to see the implication of passive investing for equilibrium prices. Now, for today's talk, I'm only going to talk about passive investing, but this equilibrium response has actually large implication when you study common questions in finance, right? If you want to think about what happens when financial intermediaries get distressed or face tighter regulations so that they have to trade more conservatively, or what happens when a hedge fund or an arbitrager goes bust, you need to take into account maybe the equilibrium response in the market. Now, how do we do this? Well, first, we're going to formalize what people mean when they say that markets are very competitive. As is clear from the example I've shown you, this is not about how investors directly compete with one another, right? It's not whether investors are price takers or not. This is like a different notion of equilibrium. It's how investors interact with one another in setting their trading strategies, right? How does my trading strategy respond to what other people are doing? Now, if you want to make some progress on this, right, you need to go a little bit further because the universe of trading strategies is very large, but across different theories of competition, it turns out that what matters in these trading strategies can be summarized by changes in demand elasticity. So essentially, how aggressive you're going to go after changes in prices. And we find that this equilibrium response can be summarized by a simple statistic that we name competition chi. And basically, it answers the question, how much does my demand elasticity respond to a change in the demand elasticity of everybody else, right? So if someone stops looking for $20 bills on the floor, how much harder am I actually going to look for the $20 bills? Now, how do we bring this to the data? Well, we're going to provide an equilibrium framework to quantify investor competition and how it impacts prices. So we're going to take a semi-structural approach. What this means, we're going to have exogenous but very flexible decision functions for investors, and we're going to solve the equilibrium of this decision function. This will allow us to be very agnostic about the foundation of investor competitions, but I'll get back to some of those foundations you might be interested in later. Now, our model is going to have a two-layer equilibrium. The first layer is going to be prices that adjust such that markets clear. And the second layer, that's what's new, is that investors are going to compete in strategies, right? Investor interactions are going to be through their demand elasticities. Now, we show how we can solve this model, and so I provide an answer to find the size of the competitive response. And we take it to the data using portfolio holdings on the US stock market from the 13F filings, and we find that competition chi is equal to 2. What does it mean? Well, the first thing you should know is that it's far from the perfect competition benchmark, which means that competition should be equal to infinity. Now, in terms of numbers that are maybe more speaking to you, well, the direct change of individual behavior is going to be dampened by 60% with a level of competition equal to 2. Right? So 60% smaller than just only the direct effect. Now, in terms of thinking about the rise of passive investing, we'll find that the rise of passive investing that we observe in the last 20 years leads to more inelastic aggregate demand curve at the individual stock level of 15%. So that's a large number. If you want to put this in, so like in terms of multipliers, it used to be that when you buy $1 of a stock, it raised its price by $2.5. Now, with 15% more inelastic demand, the price would rise to $3. So that's the headline number we have. I'm going to introduce you our framework first, then we'll see how we bring this to the data before estimating the model and then getting at the implication for prices. So the heart of our framework is really this two-layer equilibrium. The first layer, as I said, is standard. Here, investors are going to buy only one asset to keep things simple. So investor I demands demands a quantity of the asset DI. So those small letters are logs and large capital letters are levels. And you see that demand for the asset is very simple. There's a baseline level of demand, D bar I, and then it's simply decreasing in the price with respect to a reference price, P bar, with elasticity EI, right? Of course, we have an equilibrium condition where the supply of assets equal the sum of the demand. Now, this demand elasticity is important, right? It measures your trading aggressiveness. By how many % are you going to increase the quantity of the asset that you buy in response to a 1% decrease in the price of the asset, right? And we know that this matters, right? For inelastic markets, we know that flows have large impact on prices, right? If you want to translate flows into prices, 1% increase in demand is going to create 1 over the elasticity % increase in prices. And beyond the effect on prices, we know that across many theories, inelastic markets go with higher volatility, less price informativeness, and also less liquidity on markets. Now, what's new is really the second layer, and that's the competition in strategy. So the elasticity of individual investors has 2 components. First, an individual component that's specific to the investor, that's this epsilon bar I, and then how the investor interacts with all the other investors, which is here materialized by this aggregate elasticity, EAG, right? And we respond with chi times to the aggregate elasticity. Now, what this means that with no competition, investors are going to follow mostly independent strategies, right? They don't respond to one another. And with full competition, any change is going to be fully counteracted by the reaction of investors. What's nice about having this parameter, we can actually study all the intermediate cases, right? And be very granular measuring chi and estimating the size of this response. Now, finally, since it is a model of like how investors interact, we still need to close the model for the second layer of the equilibrium, and the aggregate elasticity in the market is equal to the sum of the individual elasticity. Now, let me just say a word about some of the foundations, right? So there are many economic forces that could shape this competition parameter chi. Right? There are many theories that actually would limit the ability to have a fully competitive response. So why is chi not equal to infinity? Right? For example, it could be hard for you to acquire information that would make you respond perfectly to, like you fully respond to changes in the elasticities of others. Or maybe you're facing some investment mandate and it's hard for you to change your investment strategy. Or even you can think of other behavioral theories where you don't really fully understand what others are doing, and so much that it's actually hard for you to change your behavior in response to what other people are doing. So what we are going to do here is actually what we show in the paper, that all of these theories map tightly to the two-layer equilibrium, but we're going to go directly at measuring chi in the data and going to be agnostic about which precise economic force is actually going to shape the competition parameter. Now, before I show you how we estimate the model and the data, let me actually tell you about our example and how this framework applies to the rise of passive investing. And so here I want to do a very, very simple example where we have homogeneous investors which all have the same elasticity E naught. And we're going to take the numbers that we find there's been a rise in passive investing such that the fraction of active investors actually decreased by 30% roughly over the last 20 years. So this means that if you account for just the direct effect, so the effect without any competitive response, means that elasticity has actually seen a proportional decline, right, going from E naught to now 70% of E naught. If you start accounting for the competitive response, you need to take into account the fact that the active investors are going to see that aggregate elasticity in the market has been decreasing. And so they are going to trade a little bit more actively in response, right? How much more actively? Well, that's going to depend on the chi parameter, but they are going to increase their elasticity every so slightly. So you'll see that aggregate elasticity in turn is going to increase, but then there is going to be a second round response of the active investor, and so on and so forth until we reach an equilibrium. And so you see that the final aggregate elasticity is actually the combination of the direct effect, that's the number in green, right? Alpha times E naught, that's 70% of E naught, plus the competitive response, which depends on the chi here. Okay, so if chi is infinity, that's a very interesting case. If chi is infinity, actually we are back to E naught, right? The competitive response undoes the rise of passive investing, undoes the fact that some of the active investors became passive. Now, if you plug the number that we're going to estimate, if you foresee the numbers that we have, which is chi is equal to 2, you find that actually the elasticity of the demand elasticity experienced a decline of roughly 13% with respect to its initial level, right? So remember, it's 100% if you have perfect competition. There is no change in elasticity. It would be 70% if there wasn't any competitive response. So we're roughly somewhere in the middle. Okay, now let me move to how we actually estimate chi, and then we'll actually look a little bit more deeply into the implications. So we're going to use portfolio holdings data on the US stock market from the 13F. So that has every institution with assets under management over $100 million, has very large coverage of ownership in the US stock market. And the difference with the model I've shown you is that, investors don't buy only one stock, they buy portfolios of stocks. So here again, we're going to follow the work of Ralph and Moto, who tell us that it's a good representation to write a logit in portfolio shares. That's what you have. On the left-hand side, you have relative demand. And on the right-hand side, you have this baseline level of demand that I showed you earlier, and then the price elasticity. And then the baseline, and then the elasticity, again, depends on two things. First, a baseline level of elasticity, and then that's specific to you, and then how you respond to competition. Now, you might think this is just, adding a bunch of parameters to the framework of Koji and Yogo, but actually, there's sort of like a wrinkle here because the aggregate elasticity is the equilibrium of the individual elasticity that you're going to estimate. So that poses estimation challenges. Actually, we have 3 challenges in the estimation since we have to estimate a model where investors interact with one another, as is common. We're facing reflection problems. So, and I'll give you some insights on how we can solve this in a minute. Then we have classic issues of endogeneity and demand estimations. We need to have a price instrument and also an instrument for aggregate elasticity. And last, we actually have to run this. So we had to devise an efficient algorithm to be able to solve for chi numerically. Now let me give you some insight on how we actually solve the reflection problem. So Luis, I took you as an example. I know you like to trade GameStop quite aggressively, but when I see you do that, I can't quite tell whether you are just an aggressive trader naturally, so like your base level of elasticity is actually high, or whether the people you're facing, so say Philip, Robin, Annette, and Harrison here, are encouraging you because they are quite passive to trade aggressively. So if only I could observe you trading on some other market with some other investors, maybe I could sort of like disentangle what's your own elasticity and what comes from others, right? But of course, it's not that simple, but because, to do that, I still need to know, for example, what Philip, Robin, Annette, and Harrison base level of elasticity are. So I've sort of like a chicken and egg problem, but we solve this. We actually show a condition on the graph of investor stock links that solve the reflection problem. So that's how we do it. Now, having said that, that's the estimation. Let me show you our results in the time that I have left. So first, we find that competition chi is equal to 2.15. We estimate this in the cost section. So here you see the histogram of the estimation across all the quarters, and you see that it's tightly centered around 2. So we have very precise estimation. What it means in terms of individual response, well, if aggregate elasticity increases by 1, that means I'm going to decrease my own demand elasticity by 2.15. And so again, that's very far from full competition. It's hard to compare any number to infinity, but let's imagine you would like to compensate the direct effect all the way to 90%. You need a chi parameter equal to 18. So we are sort of like an order of magnitude below that in terms of the competitive response. Now, we confirm the robustness of our results across many different specifications of our estimation. We use slightly different instruments, additional control. We weigh the regression differently. We even group investor types differently or impose that chi should be the same across all quarters. And we find that all the estimates are actually all around number 2, roughly. Now, that's not mechanical, right? Because if you do the wrong thing, say you don't use an instrument, you'll find that competition chi, so the size of the response is going to be much smaller, more around 1. So that gives you really confidence in our estimates. Now, to the subject at hand, right, the rise of passive investing, as I said, there's been lots of evidence. Here, this graph focuses on mutual funds, that there's a rise in the share of passive funds, and share of active funds actually plateaued and even declined in the last few years. In our own estimation, we find that the fraction of active investors gone down from 80% to roughly 60% in the last 20 years. What does it mean for elasticity? Well, I'm just going to redo the simple example I did earlier, but now we can be a little bit more sophisticated, right? Because aggregate elasticity not only depends on the fraction of active investors, but also the whole distribution of these investors in addition to the equilibrium response. And if you want to know the effect of a change in the active share on the aggregate elasticity, we have a pass-through formula that tells me that it's just the inverse of 1 plus the competition parameter chi times the active share. And we estimate with a number 2.15 for chi and 68% for the active share. It's just 0.4. Conclusion, elasticity is going to drop by 0.4. The pass-through times 32%, which is our estimates of the decline in the active share. So 13% is the decline in elasticity. Now, you might be worried about external validity, right? We're only using one source of variation in the active share to look at the change in elasticity. We are actually looking at different sources of variation to see that this pass-through, right, the number 0.4 is actually robust to other sources of variation. So we use in column 1 to 4, actually the panel variation in the panel to look at the pass-through, and we find that it's again between 0.4 and 0.475, so in line with the original estimate. And we also use index inclusion as a source of variation in the active share to confirm that our number of 0.4 is robust and has some external value. Now, before I wrap up, I just want to say that elasticity is not the end of the road, and as there are implications that, as I said, inelastic market goes with higher volatility, actually less price informativeness and less liquidity. And we confirm this in a regression using elasticity on other outcomes. So if you're not interested in volatility, in elasticity per se, beyond elasticity, this has implications for quantities that you might care about. Now, let me wrap up here. So we Then a couple of things. So first, we have defined investor competition, which we think is a very useful statistic to understand the effect of a change of some investor behavior by introducing this two-layer equilibrium. We have estimated this model and showed you that chi is roughly equal to 2. This means that the direct effects are dampened by 60%, and the rise of passive investing, if you have to remember one number, it's led to 15% more in elastic market. Now there's lots more applications to this, but I'll leave it there. Thank you.